Ryan Stevens here with the National Real Estate Post and Mortgage Shots. Okay, we got a bunch of great stuff here. I want to start with this one. Okay, so what we have here is we have the S&P chart. Now, you notice this is a 5-year average of where the S&P is currently at. Now, we are at an all-time high right now. This is absolutely a crazy number. Here's one way we can look at this, and we discussed this yesterday. Where have all the young home buyers gone? Well, check the stock market. The reason why we're seeing these extraordinarily high numbers in the likes of the S&P and, the Dow Jones Industrial Average is because for people who've got disposable money and they cannot afford to buy a house right now, which is an investment that you live in, build memories in, and raise your children in, and get to know your neighbors in, right? That's a hell of an investment. If you can't afford the price of admission, then you don't give a shit who's playing at the concert. Does that make sense? And so what people are doing is they're taking that disposable money, younger generations, and by the way, every statistical analysis and survey done from younger generations, they want to own homes just like me and you. We're talking about the Gen Zers or whatever they are right now, not wanting to own homes. That is just factually inaccurate. They want to own them. They simply can't afford them. And if you watch my show with any regularity, you know the numbers and they're stark. If you're 30 years old and you're married in 1960, 52% of you owned a house. And right now, in 2025, 12%. So they're taking that money and they're moving it over to the stock market. Okay, this is a big one right now. Sellers are getting ghosted. 15% of home buyer contracts were canceled in the month of September. Why is this taking place? Listen, we can go back and forth on this. And if you're a realtor lender, you probably have your reasons. And of course, I have mine. I think the biggest thing is I think a lot of that loan could be compromised. That's why underwriters tighten their underwriting guidelines. And I think that's why people get pissed off and walk away from their contracts. I think the other part of this is very clear. I think what's taking place is buyers are saying, the market is going to continue to go down and perhaps I got a higher interest rate and a higher sales price on this property. And if I pull out of this thing, I can go ahead and get a better deal going forward with another house. Now, I've said this a number of times. A contract is binding. It's contractual. And when your buyer or a buyer pulls out of a contract, you're screwing that seller. You told that seller, you gave your word. Actually, you gave your legal bond that you're going to go through and try to purchase that property. You have a lender who's gone and given you either a pre-qual or a pre-approval. So you should be able to get these things done. Yet they're starting to fall apart. I just want to show you this chart right here because I think it's kind of interesting. Going back to 2020, this is where we saw the highest peak of properties that were falling out. Why were they falling out here? Well, this was COVID. But do you remember what happened during COVID? The likes of Redfin, the likes of Open Door, and any of these fintech companies, these publicly traded companies who found themselves in contracts, did everything they could do to ditch those contracts because they thought that the market was going to completely and totally tank. Meaning they didn't fulfill their fiduciary to their buyers if they're going out there and trying to torpedo the transactions that they have in process. This is something that a local realtor and a local lender would absolutely never do because we are invested legally and morally with our buyers and sellers, not with our shareholders. That's the reason we saw that big spike in 2020. And of course, we saw this over here in 2023 again. But look we are starting to go in the same direction. Now, do you expect this number to go up or down? Frankly, I think this number is going to go up. And I think, God, I'd like to wager with you guys. What's the bet? Is it going to get above COVID? And my answer is, I think it's going to. Now, we'll see in the coming weeks, won't we? Refinance demand is up 81%. It's higher than it was a year ago, thanks to falling mortgage interest rates. Yes, we have great interest rates right now. The average contract interest rate for a 30-year fixed-rate mortgage with conforming loan balances of 806,500 is less. Decreased last week to 6.37 from 6.42%. I got to point out here, if you come and work on our team, we beat that rate. I mean, we beat it to death. But anyways, 81% higher with refinances. So I guess the question then becomes, what are the direction rates are going to go? Now, I saw somebody posted yesterday that Barry Habib said rates are going to go down to 5.5%. A very, very bold prediction. Before we jump into that, I want to talk about the second point here. ARM applications increased 16% over the week, which pushes the ARM share to 11%. What we're looking at here is the difference between the 30-year fixed and the 5/1 ARM. The 5/1 ARM is a fantastic loan. Now, you'll notice this huge disparity between the two. But if we go back to 2000, the 5/1 ARM was actually higher than 30-year fixed. So when these numbers are basically side by side as they were in October, December, when they were back in these months, there wasn't much motivation because there wasn't benefit in getting something other than a 30-year fixed. But you'll notice what's taken place over here is we have now seen a large chasm between the two. And you got to figure that your 5/1 ARM is going to be about a full percentage point lower than your 30-year fixed. It is a great, safe, responsible loan that comes with the implicit guarantee from the federal government. It's a great loan. Explain it and you'll probably be able to find more deals. So refinances are up and they'll continue to stay up provided we continue to see lower interest rates. Now, let's get on to my next point here. I heard Barry Habib said he thinks rates are going to go to 5.5%. I didn't hear that from Barry. I saw that from a third party, but let's say that's true. And by the way, very bold. According to the Mortgage Bankers Association top economist, we're not going to see rates drop below 6% anytime soon. So who's right on this one? Is it going to be the MBA economist on this side, or is it going to be Barry over on this side? Mortgage rates could remain above 6% for the next several years, according to a newly released projections from the Economist at the Mortgage Bankers Association. MBA chief economist Mike Frattoni presented the forecast at the group's annual conference in Las Vegas on Sunday, projecting that the 30-year fixed-rate mortgage is going to remain above 6% to 6.5% through 2028. I digress. Why would you hold any meetings in Vegas? Nobody wants to listen to meetings in Vegas. They want to do stuff that they can't bring home in Vegas. So right here, if we're looking at this rate outlook, 75 basis points of additional cuts from the Fed, steep yield curves. Okay, at the top, we're seeing mortgage interest rates there. That's a 30-year fixed-rate mortgage, and of course, according to Frattoni, he thinks we're going to be somewhere in the mid-sixes. We can go look at the Fed fund target rate, which continues to drop. That, of course, helps us, the Fed fund rate, because that's what our, when you finance on credit cards or mattresses or things like that, it's going to affect your DTI ratios for the better. The red one there is your 10-year Treasury, which generally tracks what's happening with mortgage-backed securities. So, if you want to find out what's happening with mortgage-backed securities, you can always look at the T-Berg on Bloomberg in the morning, and that'll give you an idea of where mortgage-backed securities are going. And, of course, we have the 2-year Treasury, which also has a similar impact on mortgage interest rates and mortgage-backed securities, and we expect those to stabilize. So rates up or down? What do you guys think? I'm kind of leaning towards Barry on this one. I think we're going to see rates go down a little bit. Now, the drop that we're getting in interest rates and the drop that we're getting in property values, I don't want to be a complete Debbie Downer on this, but part of that money is being recouped through our insurance companies. Insurance is going to be something that defines the next couple of years in the real estate and mortgage space because it has gotten completely, nuts, out of control. So we can see here, Colorado's been hit the hardest, which I find really, really hard to believe when you consider what's taking place in California and Florida. But Minnesota, Iowa, getting hit worse than California and Florida, and Colorado getting torpedoed. I understand the western states because all the fires. I somewhat understand the Midwest because of what's taking place, with the tornadoes and the floods and the hurricanes. But, I spoke a couple of moments ago about going and getting your insurance prepaid up front the day you get that damn contract to lock your buyers up so they can't walk away from the transaction because 15% are doing them, and that is irresponsible and unacceptable. But also lock it up because when we look at our insurance right now, one, in California, we don't even know if we can get you insurance. And two, if we get it, what the hell is the cost going to be? Because it could go 10% in this neighborhood, and we go 6 blocks over where you're up against the foothills, and you're going to see your insurance premiums 300% of what they were just a short year ago. All right, guys. Well, hey, listen, I appreciate you being here today. I hope you enjoyed what we had to share. I look forward to seeing you guys tomorrow. And if you have any questions, put it in the comments down below and share it with me.